Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 10th July. Coming up on today's show, President Trump announces one of his highest tariffs this week. A 50% levy is set to hit imports from Brazil from August 1st. We'll also take a closer look at results just out from Delta. Plus, a sweet deal for Kellogg's is in the works, and we'll look into who might be the next $4 trillion company after Nvidia, and why one top Treasury Department official wants the Fed Chair Jerome Powell to step down from the central bank's board of governors when his term in May ends. So, grab your coffee and let's own the morning. Need to know before the opening bell rings? Well, let's start with trade once again. Well, on Wednesday, President Trump followed through with a new round of levies, including a 50% tariff on Brazil. His letter to Brazil comes just 2 days after the BRICS summit in Rio de Janeiro, in which leaders agreed on a joint statement that criticised tariffs. Well, the US president also accused Brazil of treating its former president, Jair Bolsonaro, unfairly. Bolsonaro is on trial over an alleged coup plot, something that Donald Trump has labelled a witch hunt. And the impact on Brazil's currency, the real, was pretty immediate. It fell 2.5% against the dollar, as you can see there, just after the announcement. Now, it's worth remembering that Brazil had previously faced a tariff of just 10%. And it's interesting to note that another of those BRICS nations, India, did not respond to the president's anti-BRICS comments earlier this week, unlike Brazil. Well, India is still hoping to negotiate better trading terms with the world's largest economy. Now, the second thing you need to know about takes us to the airline sector. We've just had second quarter results out from Delta Airlines. For the quarter, it posted adjusted revenue of $15.5 billion. That's up 1% compared to a year ago. Now, according to Bloomberg consensus, that was slightly better than the expected $15.45 billion. Earnings per share came in at $2.10 versus the expected $2.07. And the closely watched total revenue per available seat came in at 19.97 cents, 3% lower than last year. And look at the share price. Now, it's up in pre-market over 9% there. Now, remember, last quarter, Delta pulled its full-year guidance as a result of trade issues and what they described as a murky outlook. Well, its CEO, Ed Bastian, told Yahoo Finance that there is now greater clarity and progress is happening on those trade deals. He believes consumers will, quote, feel a bit more confident when it comes to discretionary spending. He's also pretty bullish about the airline's premium offerings and how the summer season has kicked off. Now, Delta's share price year to date is down over 16%, and though in pre-market, as you can see, up over 9.6% now. Now, the third thing you need to know about is Bitcoin. It's climbed to an all-time high of over $112,000 on Wednesday, though it has slipped back off slightly since. An Nvidia-fueled equity rally helped push the cryptocurrency higher. We'll have more on Nvidia later in the show. So, the flagship cryptocurrency has been trading in a pretty tight range for several weeks, despite billions of dollars flowing to Bitcoin exchange-traded funds. Now, many investors still believe that Bitcoin can reach new records in the second half of this year. Just watch this from Yahoo Finance's show Asking for a Trend. Swan Bitcoin Chief Investment Officer Ben Workman explained to my colleague Josh Lipton what he believes will be powering Bitcoin growth in the coming months.
Well, what are the catalysts, what are the tailwinds that you think drives Bitcoin higher?
There's some significant tailwinds that are coming. We're seeing the regulations easing. You've got the Clarity Act coming out, which is going to put definitive clarity around Bitcoin as a digital commodity versus several others that are digital securities. So we're seeing some help from the regulations, but really the big trend that you're seeing is the adoption from corporations. And you're seeing the emergence of these Bitcoin treasury companies that are utilizing the scarcity of Bitcoin, the fixed supply, and they're arbitraging that against the lack of scarcity in the US dollar, but they're providing products through different types of securities that institutional capital can buy. And the institutional capital pools are very deep, and they're coming for Bitcoin.
About the proliferation of Bitcoin treasury companies, you have seen Jim Chanos, by the way, beefing with Michael Saylor of Strategy about this, right? And I'll read you what, and Chanos had some strong thoughts about this. They were kind of talking about the value of the company. And Chanos told Bloomberg this. He said, there's a wonderful sales job that's being done about the fact that this is an economic engine in and of itself. He says, therefore, terms like Bitcoin yield, this is Chanos, are used, and I've called them financial gibberish because they are. What do you say to that, Ben?
I think there's a lot of misunderstanding out there still around this industry. People are still trying to get up to speed with what it means to be a Bitcoin treasury company. Mm-hmm. And what that means is you're trying to acquire Bitcoin on behalf of your shareholders. And when you're doing that, your primary metric with every transaction you undertake is how much more Bitcoin is backing each share of common stock. So Bitcoin yield represents the pace at which you're accumulating that Bitcoin. So these are different concepts for the traditional financial markets to grasp, but what he thinks he's doing is the same trade as Michael Saylor, and historically, this type of a short position hasn't worked out all too well.
Time for trending tickers, and one ticker that's definitely trending this morning is Kellogg's. Shares soared as much as 50% in the pre-market trading. Let's have a look at where they are right now. And as you can see, they're up above 50% now in pre-market. And that's happening on the news that Italian chocolatier Ferrero is nearing a deal to buy the firm. The tie-up would bring many of the world's most recognizable food brands under the same umbrella. Now, Ferrero is the company behind Nutella, Kinder, Eat Natural, and dozens of other brands, while Kellogg's makes the popular Cocoa Pops and my personal favourite Crunchy Nut cornflakes. Now, the Wall Street Journal was the first to report details of the deal, which is said to be worth roughly $3 billion. Now, to be clear, WK Kellogg was spun off from the Kellogg Company in 2023. The Michigan-based company has recently lowered its forecasts for sales and core profit due to subdued consumer spending. Now, on the other hand, the Nutella maker posted strong financial results earlier this year, generating more than $21.5 billion in revenue. Ferrero, which is a family-owned company, has been targeting the US for acquisitions. It's already bought ice cream maker Wells Enterprises and Nestlé's US chocolate business. Now, moving on from chocolate wafers to wafer chips and semiconductors. Another stock that's seeing sweet gains this morning is TSMC. The New York listed shares of the chip manufacturer were up 1.3% after TSMC reported better than expected revenue in the second quarter. They're up actually 1.75% now. Now, the company's revenue for April to June came in at nearly $32 billion, according to Reuters. That's plus 39% on the same period last year. The world's largest contract chip maker is due to report full Q2 earnings next Thursday. It's set to be a closely watched release as the rise of AI continues, and TSMC is well positioned to benefit from the extended boom. Clients of the Taiwanese giant include the likes of Nvidia. And speaking of tech and AI giants, our third trending ticker today is Microsoft. The tech company was up 1.4% on Wednesday at a new record high. At this pace, Microsoft could potentially join Nvidia in the $4 trillion club. Now, analysts at Oppenheimer upgraded Microsoft to an outperform rating and set a $600 target, highlighting Microsoft's AI potential and its growth in cloud computing. Microsoft has just completed another round of AI-related layoffs, and the company have reportedly touted big savings thanks to AI automation. According to Bloomberg, a top executive said that AI had already saved Microsoft more than $500 million last year in call centers alone. Yahoo Finance has sought comment, but we didn't immediately receive a response. Now, as big stocks soar, we're going to take a moment to talk about dividends. While Microsoft was the largest distributor of dividends last year, dividends for the S&P 500 as a whole are nearing record lows. So, do investors still care about steady income from stocks? Well, Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments, joined Opening Bid to explain why more companies are opting for buybacks over dividends. And she shares her top pick for a dividend stock.
Where in the world Have all the dividends gone? I'm definitely not singing that song. I think it's from the mid to late 90s. Whatever it is, I'm not singing it. Get this stat from Deutsche Bank. S&P 500 dividend yields are now within just 20 basis points of their all-time low, last reached during the tech bubble in 2000. Victoria, why don't investors care about dividends anymore? I mean, this is supposed to be a predictable stream of income. Comes to you, every quarter? You could just reinvest it and you get rich in 30 years.
Well, I don't know, because Brian, I do care about dividends, and I like to see dividends on the stocks in our portfolios. And so I think investors should be paying attention to this. It helps provide a little bit of a buffer to the volatility that you see in the marketplace. It gives you a little extra income and cash flow coming in. So I like to see a dividend, but I do think a lot of corporations now are saying, wait, we can do buybacks instead of dividends. It's more discretionary. It gives corporations a little more leeway in what they're doing, and they can use the cash that they were going to pay dividends to perhaps do other things like acquisitions, invest back in the company in other ways. So I think they're kind of selling it to investors as there are better ways to put our money to work than just giving a dividend. We're going to do something instead that's going to provide growth in the future. I think that's the setup, but I still like to see a dividend on my stocks.
Oh, good point. I think I will go off the rails if I express my hatred for stock buybacks. I can't stand them. But Victoria, real quick, do you have a favorite dividend stock or two?
I do. If you're going to play a stock just for dividend, I think you look at Verizon. You've got something at a very reasonable valuation of 10 times. You've got over a 6% dividend in a company that's paying down debt, increasing cash flow. They're looking to buy Frontier Communications next year, which increases their broadband subscription. So I think Verizon's a great dividend stock for your portfolio.
Keith, is someone crunching the number on the S&P 500, looking at corporate earnings, cash flows? How important is it that companies are paying higher dividends when you come out with certain calls for the market?
It's not the main driver. The reality is we are likely to see an all-time payout this year, even though that dividend yield is lower. But I think part of this is structural too, Brian. If you look at the overall composition of the market, as I mentioned earlier, 45% plus is tech and growth sectors, and those tend to be lower dividend sectors. And then you look at historically, what have been some of the larger dividend sectors, they've had some challenges. The energy sector, pharmaceuticals, utilities is a little bit different, but then real estate as well. So I think that's part of it. As Victoria mentioned, it also gives, by not doing the dividend, which enforces discipline, because you don't want to cut that, by going buybacks, companies have more discretion as well. I agree with Victoria, though. The dividend, having that discipline is healthy, but it makes sense to me that the market composition has shifted so much. And it's not the key driver in our view, especially when you have a dominant theme, which is AI driven, and you're seeing a lot more capital spending from these big mega caps as opposed to the dividends. One last point, Brian. I do think we're going to start to see a big pickup in the second half, especially in financials with some of the deregulation past the stress test.
Allie, where are the special dividends from Palantir and NVIDIA?
Wouldn't that be
Victoria
great,
thinks
Brian?
I'm crazy.
Victoria,
yeah, it's okay, Victoria. It's all right. We'll take it offline. It's cool. Go ahead, Allie. Go ahead.
No, but I totally agree with everyone's points here, right? I think we're in a high growth market. Retail trader is really leading the charge. And, those companies just don't have the dividends like some of these more value plays.
So if you're looking for income from stocks now, you'll know where to go. We'll be back after the break with Yahoo Finance's exclusive interview with the Deputy Treasury Secretary. Welcome back to Market Sunrise. It's time now to hear from Deputy Treasury Secretary Michael Faulkender, who spoke to our colleague Jennifer Schoenberger in the US about interest rates, the new Fed chair, and the future of Jerome Powell.
If you look at our interest rate environment compared to other places around the world, there seems to be cause for bringing interest rates down. Now, again, I want to be careful because at Treasury, we stay in our more fiscal policy lane, and the Federal Reserve conducts monetary policy. But I think one is hard pressed to look at the data and come to the conclusion that we are in an environment where inflation is a significant challenge to the economy. I think the economy would be much better served by reevaluating the current policy determination of where interest rates are currently at, given the fact that, as you said, we have strong evidence in the data that we are not seeing inflation To the extent that we see it, it's primarily been in housing, and we know that housing inflation occurs with a lag. So I think that the economy would be well served by the Fed taking another look and identifying whether it truly is currently in the right spot on interest rates.
Well, speaking of the Federal Reserve, the president called again on Fed Chair Jay Powell to resign immediately during the cabinet meeting on Tuesday, and then turned to Treasury Secretary Scott Bessent and said, "I like you better." At the same time, we saw a report out this morning that the current chair of the Council of Economic Advisors, Kevin Hassett, looks to be one of the favorites as well, Bessent on the short list. Has the interview process started for the next Federal Reserve Chair? And what can you tell us about who is most favored right now?
So what I would say is that the president talks to people all the time. So rather than saying that there's a formal interviewing process, just as he did when he was filling out his cabinet, which we have, the reason that this administration has been able to accomplish so much is because of the extraordinary talent that the president has selected to be part of his cabinet. And so he is constantly getting ideas from people. And as we saw, he cast a wide net. He talked to a lot of people, and he is going to, I presume, do the very same thing when he is picking the next Fed chair. He is going to cast a wide net. He's going to talk to a lot of people, and he is going to pick, I know, a fantastic new Fed chairman. Beyond that, I can't say that I've seen a short list or know who exactly is on that list, but based upon how well the president has selected people to serve in his second administration, I have no doubt that he will find us a fantastic next Fed chair.
And does the administration want Fed Chair Powell to step down from the Fed Board of Governors after his term is up as chairman in May of 2026?
It has traditionally been the case that when a Fed chairman term ends and they're no longer going to be chairman, that they don't stay on the Board of Governors. I presume, I would hope that Chairman Powell follows tradition along those lines.
The big beautiful bill, now law, signed on July 4th. How many jobs could we see created from this bill, and how much could it boost GDP?
Right. So the law that the president signed last Friday is the core of the economic program for the administration. Critically important that we extend the 2017 Tax Cuts and Jobs Act, as well as implement a number of new pro-growth tax initiatives. So no tax on tips, no tax on Social Security, no tax on overtime, the immediate expensing of capital equipment purchases, the immediate expensing of factory construction, the R&D tax credits. All of these are going to be boosts to growth. But most importantly was making sure that we didn't have a $4.5 trillion tax increase go into effect in December, which is what would have happened had this legislation not been signed by the president. So the most important thing, and as a result of that, we are going to, as well as with the trade activity that we were discussing earlier, as well as the deregulatory agenda of the administration, we are creating an environment where capital around the world wants to come into the United States and be put to productive use. So we are going to see enormous job opportunities for the American people as a result of all of this investment that's going to be taking place, because we are fixing and extending the tax system here in the United States. So there's enormous potential for there to be both significant increases in employment opportunities as well as job opportunities. Because again, when we're building construction jobs, when we're creating manufacturing jobs, when we are identifying new avenues of investment in the private economy, that is where productivity improvements come from. It is not from government, it comes from growth in the private sector. And so by unleashing capital in the private sector, by improving productivity, we are going to see the opportunity for enormous wage gains for the American people. This is not just theoretical. We saw it in the first term, right? If you go back to the results following enactment of the 2017 Tax Cuts and Jobs Act, you saw the lowest unemployment rate in 50 years. You saw wage gains for line and production workers exceeding those for supervisory workers. You saw the lowest poverty rates on record across all demographies. So by providing certainty, by providing permanence to those tax components that we put in place back in 2017, we are going to maintain and extend the economic record that served the American people so well in the first Trump term, and as the president said, unleash a golden age.
A man who keeps his cards close to his chest. Well, it's time for another short break now, but join us after the break to find out what's moving the markets. So let's take a look at what's moving markets. Well, on Wednesday, Nvidia led a tech-fueled rally that saw the AI company leap to become the world's first $4 trillion public company. The chipmaker has already surpassed Apple's $3.92 trillion valuation it reached last December. And Nvidia's rise to a $4 trillion company has had implications in the markets in Asia today. Tech stocks there also rose sharply. In fact, since early May, Nvidia share price is up more than 40%. That coincides with when President Trump first signaled a thaw in his trade war with China, and Nvidia struck a series of multi-billion-dollar deals in the Middle East. The stock's recent rally follows a sluggish start to the year when the emergence of Chinese discount AI model developed by DeepSeek shook confidence linked to the sector. Nvidia's soaring market value underscores Wall Street's confidence in the rapid growth of AI, with the company's high-performance chips forming the backbone of this technological advance. Optimism around trade partners reaching deals with the US has recently lifted stocks, with the S&P 500 hitting an all-time high. Nvidia accounts for 7.3% of the index, with Apple at 7% and Microsoft at 6%. Microsoft is actually the second most valuable US company, worth $3.74 trillion. In fact, Nvidia is now worth more than the combined value of the Canadian and Mexican stock markets. But one note of caution, perhaps. While Nvidia's chips dominate the AI industry, the likes of Amazon, Microsoft and Alphabet have faced pressure from investors to rein in heavy AI spending. And while Microsoft keeps inching closer to that coveted $4 trillion mark, other behemoths in the Mag 7 like Tesla and Apple have actually been trending down lately. Well, before we go, one of the media industry's key events of the year is getting underway. Allen & Company's annual conference in Sun Valley, Idaho, is often where deals can get made. Ali Canal has had a look at what to expect.
This is the site for a lot of deal making for tech media companies, and already we've seen the arrival of some pretty star-studded names. Sam Altman from OpenAI, for example, he was among those early arrivals. I'm sure there will be some interesting meetings there after Meta CEO Mark Zuckerberg tried to poach some of that AI talent, perhaps this budding rivalry over in Idaho. We also saw the arrivals of Apple CEO Tim Cook, former Meta COO Sheryl Sandberg, Bob Iger from Disney, Andrew Jassy from Amazon. So a lot of these high-profile names within tech and media. Now, in terms of deals, I am focused on Warner Brothers Discovery. We saw the rebrand, I guess you could say, of HBO Max. Remember HBO Max? That was the original name of the streaming service. Then they rebranded to Max, and now we are back to the OG HBO Max. And this comes after Warner Brothers Discovery said that they will be splitting up their company into two separate publicly traded entities, one focused on studios and streaming, and the other focused on linear networks. Now, the big question at Sun Valley is who will be a buyer of these declining linear networks? Perhaps CEO David Zaslav will make his pitch there. I also think there's going to be a big focus on the role of artificial intelligence, how businesses are using that in their everyday workflows, how that's improved productivity. There's certainly a lot of potential deals that could be made on that front. Another area of focus is also going to be Trump 2.0. How have these various policy shakeups impacted the thinking of these executives and what we still have yet to see, especially when it comes to deregulation? So a lot to keep track of. This conference, always buzzy, and I'm sure we're going to see more news trickle through over the next week.
There's a great insights there from Ali Canal. And that is Market Sunrise for this morning. Stay tuned to Yahoo Finance. I'm Ramzan Karmali. Go own the morning.